So what you need to really understand is that central bankers don't know really what else to do. They're just kind of throwing things up on the wall and hoping that something sticks. And if their true goal is to stimulate the economy, they're really doing a poor job at it. But what's their response? Well, double down and get a whole lot more aggressive. But the problem is everything that you just saw, the negative interest rates, the QE to infinity, you know, the policies that are divergent, all of this is untested. And they can keep things invisible. They can make most people think that everything is just fine, just as it was prior to the crisis, until they can't. So it goes slow, 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 and then bam, overnight, you lose all choices. So part of it is, you know, when do you want to know? Because while they've managed to reflate the markets for a while, and some of the tools, the margin, stock buybacks, direct injections, I mean, all of these markets are correlated to those behaviors. It's all manipulation. But despite their efforts, there was a shift that started in 2014. So they're losing the ability to keep the visibility postponed, in my opinion. And you're going to see for yourself why I'm saying that. Because truthfully, when there is a shift in the pattern, it is a signal. And that's why I'm saying warning, warning. There is danger ahead. We are likely to go over the waterfall. Frankly, we could go over it any time. But let me show you what I'm talking about. I will start with the stock market because something changed in there in 2014. And the area that I want to show you at the moment is I want you to focus on this top right here, okay? Because, and look at the trajectory, right? So what you're seeing is a difference in a pattern. Now, for one thing, we've talked about this, so I'm just going to remind you briefly on it. Now this area in here is the volume on the exchange, which are the number of shares that are traded. It's pretty clear to see that the volume has been trending down, and in fact, by the time it hit here, it was 75% fewer shares that were trading hands on the exchange than there were in 2009. This whole while, the stock market was moving up. So when a market moves up on declining volume, that is an indication of market manipulation. And you just saw there are more tools that they've used, but you just saw 3 tools that they use to do that and why the markets are correlated. However, in 2014, there was a shift in the volume and it began to escalate. But when it did that, the markets were starting to break down. So what that is an indication of are the insiders, the guys that know what are going on. Wall Street is selling into this very toppy, it's near a market high. Again, transferring the risk from the few to the many in this case, so that when this market implodes, who's mostly left holding the bag? And in fact, you might recall this discussion where we were talking about all of the foreign governments selling the treasury bonds, but yet the interest rates have been pretty stable and pretty much non-existent. And the question was, who's buying them? And the first answer was mutual funds. Okay, that's who's been buying these secondary treasury bonds because there is no market for them. They are not liquid. And we'll come back to the liquidity in a few minutes. So I want to look at this area and this area more closely. Okay, now in 2014, remember, the market started breaking down in a very pervasive way. This, the breakdown of the U.S. Treasury market, when it failed, that was a very, very big deal. Now, let's look at the volume. Okay, this red line here, now where it looked gray before, it looks red and black. The red indicates that that was a down day. The black indicates that that was an up day. But this red line right here is the moving average. It's a 60-day moving average. So what that means is every day for the last 60 days, they total up the average number of shares traded, and they divide it by 60, and they get an average. And so what that really does is it just smooths out the trend so you can see it a little better. Okay, if you use this line here as sort of a benchmark, you can see that the volume started to increase. Okay, here's that line in that area. But look at what happened in February. It started to decline. And not only did it start to decline, but it started to decline as the market was moving up. Okay? Guys, that is an indication of manipulation, because in a free market, just think about this. When demand exceeds supply, that's when prices are supposed to move up. In a free market economy, that's exactly what happens. When demand, which is what this is showing you, when demand declines, markets decline. So what I find quite interesting in this volume, and why I'm spending so much time in it, is as the market showed cracks, right? These are all major corrections in here. We saw an increase in volume. Definitely for me, plus I look at these things underneath even more deeply than this, I could tell you, go to the NASDAQ website, pick any stock you want, IBM, Johnson & Johnson, Pfizer, any of them. I've shown you those graphs before. The insiders are selling into this market, capturing gains somewhere near high. If you still own these fiat money products, what can I say? I mean, this is what they do before a market crash. And truthfully, if you look at it, the level of the stock market does not reveal economic reality. Now, some